The question is no longer just how money is created, but who truly owns the future. We must look at August 15th, 1971. On that day, the final anchor was cut. From the first goldsmiths to the modern digital ledgers, money has moved further and further away from reality. When confidence collapsed, credit froze. Banks faced insolvency. Goldsmiths were among the few people equipped to store large quantities of metal securely. Money was no longer just a physical object. It became a claim, a promise. While the goldsmiths in London were perfecting the receipt system, the great banking houses of Italy, like the Medici, were transforming money into a political weapon. This was the birth of fractional reserve banking. Banking feels ordinary today. We deposit money, use cards, and assume banks simply move wealth from one place to another. But that is not how banking actually works. Modern banks do far more than store money. They create it. To understand this, we must go back to a time when wealth was physical, heavy, and difficult to protect. For centuries, gold and silver were the primary forms of money. Carrying large amounts of metal was risky. Theft was common. Loss could be devastating. This problem created an opportunity. Goldsmiths were among the few people equipped to store large quantities of metal securely. They had vaults, guards, and reputations built on trust. People began depositing their gold with them for safekeeping. In return, goldsmiths issued written receipts. At first, these receipts were simple proof of ownership. But something unexpected happened. People began trading the receipts themselves. Instead of withdrawing gold to pay for goods, merchants handed over the paper. Money was no longer just a physical object. It became a claim, a promise. While the goldsmiths in London were perfecting the receipt system, the great banking houses of Italy, like the Medici, were transforming money into a political weapon. They didn't just store gold. They created a network of international credit that funded the Renaissance. They invented the Bill of Exchange. This was a document that allowed wealth to travel across borders without a single coin ever leaving a vault. For the first time, power was no longer just about who had the largest army, but about who had the most sophisticated ledgers. Banking became the invisible foundation upon which empires were built. The goldsmiths noticed something else. Depositors rarely came to withdraw all their gold at once. Most of the time, the metal sat untouched in vaults. If only a fraction of depositors demanded their gold at any given moment, the goldsmiths realized they could lend out part of the stored metal while still meeting withdrawals. They began issuing more receipts than the gold they actually held, lending these promises to borrowers in exchange for interest. This practice worked as long as trust remained intact. But in reality, there was now more paper money circulating than physical gold backing it. This was the birth of fractional reserve banking. But this system of promises had a fatal flaw. It relied entirely on the illusion of availability. Imagine a bank that holds 100 gold coins, but has issued 1,000 receipts. As long as everyone believes the gold is there, the paper is as good as gold. But the moment that belief fractures, the illusion collapses. This is the bank run. It is a psychological contagion. When one person doubts, everyone doubts. In a matter of hours, centuries of accumulated trust can evaporate, leaving behind nothing but empty vaults and worthless paper. This is the price of leverage. This system allows banks to keep only a portion of deposits in reserve, while lending out the rest. Every loan creates new money in the form of bank deposits. Banks were no longer passive intermediaries. They became engines of economic expansion. Governments quickly realized the value of these institutions. They borrowed heavily to fund wars, infrastructure, and administration. In exchange for financial support, banks received legal protections and exclusive privileges. Banking and political authority became deeply connected. But with this connection came new risks. If too many depositors demanded their money at once, banks would collapse. To prevent total collapse, governments had to step in. They created central banks to act as the lender of last resort. But this protection created a paradox known as moral hazard. When banks know they are too big to fail, they are no longer afraid of risk. They lend more aggressively. They create more debt. They gamble with the public's stability, knowing that if they lose, the state will print the difference. The safety net designed to protect the economy ended up incentivizing the very behavior that destroys it.
Today, we have reached the final stage of this evolution. We no longer live in an economy fueled by savings. We live in an economy fueled by permanent debt. Every mortgage, every student loan, and every government bond is a new drop of digital money created out of thin air. Our entire global civilization is now built on the promise of future labor. We are spending tomorrow's wealth today, hoping that the system of credit never stops expanding. But in a finite world, can infinite debt truly exist?
But to understand why the system reached this level of fragility, we must look at August 15th, 1971. On that day, the final anchor was cut. The United States officially severed the link between the dollar and gold. In an instant, money stopped being a claim on a physical asset and became a pure instrument of government decree. This is the era of fiat money. Without the golden anchor, there was no longer a limit to how much debt could be created. The printing presses were unleashed. The global economy entered a state of infinite expansion, fueled by nothing but authority. This wasn't just an economic shift, it was the ultimate consolidation of power over the value of your labor.
The crisis of 2008 revealed the scale of this vulnerability. Years of aggressive lending and complex financial products had created a machine of debt. When confidence collapsed, credit froze. Banks faced insolvency. Governments and central banks responded with unprecedented measures. Interest rates were slashed. Trillions of dollars were injected into financial systems. These actions stabilized markets, but they also left a lasting scar. Debt increased, inequality widened, trust in institutions weakened. The world realized that banking built on credit can generate prosperity, but it also concentrates a risk that can paralyze the entire globe.
This brings us to a fundamental realization. From the first goldsmiths to the modern digital ledgers, money has moved further and further away from reality. We have replaced physical value with a system of pure belief. A system where debt is the engine and trust is the fuel. But trust is fragile. And as we move into an era of digital currencies and unprecedented central control, the question is no longer just how money is created, but who truly owns the future. Once you see it, you can't unsee it. In the next chapter, we look at the invisible hands controlling this machine.